How's everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. First, I just want to say I appreciate everybody hanging in there with me. I know I didn't have any episodes last week, but I've got a whole slate of stuff this week, and it's going to be an interesting week. I'm calling this Report Week. So I've got 8 bank reports that I wanted to cover with everybody, and I got a little backed up because of all the issues I had last week. So I'm going to be doing basically 8 episodes this week. They're going to come out Monday through Sunday. I'm going to actually double up with 2 episodes on Friday. So like I said, we're going to cover a whole slew of reports that just came out over the last couple of weeks. I hope everybody will enjoy the onslaught of nonstop banking information. But it's also a very interesting week because this is actually Stonier Week. So this is for anybody who doesn't know, the American Bankers Association has the Stonier Graduate School of Banking, which I will be down at this week. I'm very excited for that. So all week it's Stonier Week. And Stonier basically starts on Thursday and runs Thursday to Thursday, so into next week. So that will be the deal. So more, if anybody follows the BND Strategy Room on Saturday nights, keep an eye out. I'll have some announcements throughout the week about what we may or may not be doing this weekend with that. But with that being said, I'm going to kick off. So what are we covering? Our first report of the week here. We're going to be covering the quarterly FDIC Banking Profile. So this is covering for the first quarter of 2025. I always like to cover these reports every quarter because they're one of my favorites. I think they're great. Now, if everybody recalls, the way that this report breaks down, first it covers the banking industry as a whole, then it goes down into community banks, and then it basically gets into the deposit the DIF, the deposit insurance. I'm sorry, I couldn't blanked on that acronym for a second. So the Deposit Insurance Fund Reserve Ratio. So the DIF reserve ratio. So, and we'll take a look at that. But first, I want to blow this up so that everybody can see this. So let's get into what was going on with all institutions. So net income increased from the prior quarter, led by higher non-interest income. Quarterly net interest margin ticked down from the prior quarter. Asset quality metrics remain generally favorable, though weakness in certain portfolios persisted. Loan growth remained tepid, and domestic deposits increased for the 3rd consecutive quarter. That's good. And the Deposit Insurance Fund Reserve Ratio increased 3 basis points to 1.31%. So, and I'm not going to go through every single one of these. I'll just hit what I think are kind of like the most important. So net income increased from the prior quarter, led by higher non-interest income. So quarterly net income for the 4,462 FDIC insured commercial banks and savings institutions totaled $70.6 billion, up $3.8 billion or 5.8% from the prior quarter. The banking industry reported an aggregate return on assets of 1.16% in the first quarter, not too bad, up from 1.11% in the fourth quarter of 2024 and up from 1.09% in the year ago quarter. The quarterly increase in net income was led by higher non-interest income, up $5.4 billion or 7%. Gains on non-interest income were due to market movements and volatility, as several large firms reported mark-to-market gains on certain financial instruments in the quarter. Industry non-interest income also benefited from the other one-time items, such as gains on loan sales. Lower losses on the sale of securities also contributed to the increase in net income. Quarterly net interest margin ticked down. Non-interest expense declined modestly. Provision expense increased from the previous quarter and 1 year earlier. So this is important. So quarterly provision expense totaled $22.5 billion in the first quarter, up $66.5 million or 0.3% from the previous quarter, and up $1.9 billion or 9.1% from 1 year earlier. The reserve coverage ratio, the ratio of the allowance for credit losses to non-current loans, was 177.5% in the first quarter, slightly below the 177.9% reported in the previous quarter. The industry continued to build reserves as provision expenses exceeded net charge-offs by $1.2 billion for the quarter. So what you have to ask yourself there is, like, why would the industry be basically padding is provision expenses. It's allowance for loan losses. Well, we have this thing called the maturity wall coming, where basically it's hitting this year and then 26, and then it peaks in 27. So, banks obviously are expecting they're expecting some bad credits. They're expecting some charge-offs, expecting a few things in the next, couple of years are going to go badly. So they're basically padding the loan loss reserves right now, anticipating what may be coming over the next, year or two. So asset quality metrics remain generally favorable, though weakness in certain portfolios persisted. Multifamilies have grown in most part of the last year. I'm just looking to see if there was any significant things there. Yeah, not really anything too crazy. Here's another important one. Unrealized losses on securities decreased both quarterly and annually. So unrealized losses on securities totaled $413 billion in the first quarter, down $67.5 billion from the prior quarter and down $103 billion, 20% from the first quarter of 2024. Longer-term interest rates, in particular the 30-year mortgage and the 10-year treasury rates decreased in the first quarter, increasing the value of securities reported by banks and lowering unrealized losses. Unfortunately, those rates have since gone up, and thus increasing these losses. And I just want people to understand, while this may be improving, this is still a major, major issue for the industry. This is a big overhang, and this is what did they used to call that? The sword of Damascus. If I'm saying that right, I'm thinking. Basically, it's like the sword hanging over your head that waiting for that to drop and lop your head off. I know that's a little morbid, but that's kind of that is the analogy there. So this, again, I've been harping on this for well over a year. It's just something we really got to keep an eye on. So banking industry assets increased in the first quarter. Loan growth remains tepid. Domestic deposits increased for a third consecutive quarter. That's good. Equity capital rose from the fourth quarter of 2024. The number of problem banks decreased in the first quarter. So the number of banks on the FDIC's problem bank list decreased by a net of 3 in the first quarter to 63 banks. The number of problem banks represented 1.4% of total banks in the first quarter, which is in the middle of the normal range for non-crisis periods of 1% to 2% of all banks. The total number of insured institutions declined. So the total number of FDIC insured institutions declined by 25 in the first quarter to 4,462. During the quarter, one bank opened, one bank failed, and did not file a recall report in the prior quarter. One bank was sold to an uninsured institution, and 25 institutions merged with other banks. Okay. Let's now scroll down to community banks real quick. And we're getting there. Okay. Community bank performance. So, so quarterly net income increased from the last quarter. Quarterly net interest margin increased from the last quarter and last year. Asset quality metrics deteriorated modestly, but remained favorable overall. Loan growth continued in most portfolios, and domestic deposits increased from last quarter and last year. So, overall for community banks, things seem to be going pretty well at the moment in the first quarter of this year. I mean, nothing really too crazy. I mean, obviously they're continuing to keep an eye on their portfolios, but net interest margin increased from last quarter and last year. Net operating revenue decreased in the first quarter, just a little bit though, not much. Non-interest expense decreased quarter over quarter. Provision expense decreased from the previous quarter, so that's kind of interesting. The quarterly provision expense of $1.1 billion was down $249 million, or 19% from a quarter earlier, but up $271 million, or 34% from a year earlier. So the reserve coverage ratio decreased 11.1 percentage points from a quarter earlier and 41.5 percentage points from a year earlier to 168.8%, as non-current loan balances increased faster than the allowance for credit losses. So, so that's kind of interesting. So the quarterly provision went down, but the non-current loan balance increased faster than the allowance for credit losses. So that's kind of an interesting thing there. I think that would definitely, definitely want to look a little closer at that one. Asset quality metrics remain favorable despite modest deterioration. Unrealized losses on securities decreased from the previous quarter. Yet total assets increased. Loan growth continued in most portfolios. So, still seeing, loan and lease balances increased 15.1 billion from one quarter earlier. Growth was broad-based across all major portfolios except agricultural, production loans, auto loans, and credit card loans. So that's interesting. Increases in non-farm, non-residential CRE loans up 7.9 billion. Led quarter-over-quarter growth. More than half of community banks, 59%, reported quarterly growth in total loan balances. So that's good. I mean, that's great. So they're seeing. So while all banks overall seeing very tepid or weak loan demand, community banks still rocking it pretty good here. Domestic deposits increased, capital ratios increased, and then one community bank failed in the first quarter. Okay, and then let's very quickly go down and take a look at the diff. Okay, insurance fund indicators. So deposit insurance fund increased by 3.8 billion. The diff reserve ratio rises 3 basis points, ends the first quarter at 1.31%, and one institution failed during the first quarter. So during the first quarter, the deposit insurance fund balance increased by 3.8 billion to 140.9 billion. The rise in the diff was primarily driven by assessment income of 3.2 billion. Interest earned on securities, negative provisions, and unrealized gains on securities also contributed a combined 1.2 billion to the fund during the quarter. These gains were partially offset by operating expenses of 0.6 billion. One institution failed during the first quarter. So everything seems to be going okay with the diff as of right now. No big issues. Nothing really happening on the horizon. So that is our quarterly banking profile for the first quarter. Obviously, some things to still keep an eye on, but overall, not horrific, not great, but not horrific either. Community banks continue to do well. The deposit insurance fund is doing well. Overall, in the banking industry, things seem to be doing okay. M&A seems to be a little bit muted with only 25 banks completing mergers there in the first quarter. But we shall see how the rest of the year goes. But with that, I will wrap up and basically say keep an eye out. Report week is just starting. I got a lot more stuff coming the rest of the week. And looking forward to bringing it all to you guys. But with that being said, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, please check out some of the other content on the channel. I hope everyone has a great day out there, and I will see everyone again real soon. Thanks a lot.